Hello and welcome to Super Simple Spread Trades for Income, created and presented by myself, John Locke, and brought to you by SMB Training. Before we get going, we need to go over some important information, and that is to let you know that the presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please note that the risk in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And also note that every presentation and example in this program are hypothetical computer simulated trades, and they're believed to be as accurately represented as possible. However, live results may vary. Also, please trade responsibly. Trade appropriately for your net worth and your experience level. We have some suggested maximum capital guidelines, and keep in mind these are maximum guidelines. If you're an experienced options trader with extensive experience trading with the system that you're trading with, you should have a maximum planned capital of $20,000, 20% of your net worth, or a maximum planned risk of 3% of your net worth, whichever is less. If you're a newer options trader or if you're anyone in between, it should be less than that. So make sure you're trading appropriately for your experience level and for your net worth. A little bit about myself. My name is John Locke. I'm president of a company called Locking Your Success LLC. We started out as a success and life coaching company. We have migrated into trading performance coaching and mentoring. We have several trading systems available through SMB Training that go from the more beginner, like this one's going to be, to very, very advanced professional level courses that train professional options traders. I'm also a professional trader on SMB Trading Desk, and I'm certified in NLP or Neuro-Linguistic Programming, as well as Neuro-Linguistic Repatterning and Ericksonian Hypnosis. We use these skills to help traders perform better and follow their systems and essentially get better results from their life. Moving on, I'd like to talk a little bit about analytical software before we get going. There are several different types of analytical software when it comes to analyzing complex option spreads. OptionView is the platform that we use to develop strategies and to trade with is OptionView, and I strongly recommend this for this program and all of my programs, as well as anybody who's doing complex option spreads or multi-legged option spreads. Some of the other platforms available out there are fine if you're doing straight puts and calls. They're actually okay if you're doing verticals, just straight verticals, but as soon as you get into more complex positions, the T+0 line gets wacky. It gives you improper complex position Greeks and a T+0 line that does not display what's going to happen when the price moves to your profit and loss. Therefore, it becomes very difficult to manage the trade that way. Not only is it not accurate, but it's not consistent. So for those reasons, we use OptionView software, and we do that because currently OptionView is the only software on the market that uses true delta and gamma numbers, and it is the only software that allows you to combine put and call skews, both of which are necessary to properly analyze complex options positions. The use of less sophisticated analytical tools will substantially affect your trading performance because you're kind of randomly guessing at what your position really is. So please take that seriously and consider investing in OptionView. The Super Simple Spread Trades trading program is designed for several different types of options traders. First, it's designed for traders who are at a beginner's level with complex options and would like to get some experience income trading, as well as those traders who may be more experienced options traders and they're looking for some simple, effective strategies that require very little attention. It's also for those income traders who've been struggling for years, losing money, jumping around between multiple complex strategies, making little or no progress. It's for you that I'm going to demonstrate 4 simple improvement strategies and hopefully change your perception about what high probability trading is and how to make money with high probability trading. These strategies are known as the bull, the super simple bearish butterfly, the bull versus the bear, and the V condor, which is a simple strategy, a somewhat simple strategy, but it's not exactly super simple. But by the time we get to that, we should be all set. So these are trades that tend to perform well in a large variety of market environments. But one thing you need to remember, as with all rule-based trades, there are going to be certain market conditions that are going to be problematic and they should be avoided trading these as is. So just keep that in mind going forward, and I'll talk about those environments with each individual trade as we go through them. For now, I'd like to talk about odds. If and when to do adjustments, or if it's even worth it to do adjustments. And I'd also like to talk about losing to show you how to become a more profitable trader. I'd like to ask, what do you think is the highest probability positive theta trade that we can make and still make a decent amount of money? Is it the high probability iron condor? Is it a low probability iron condor? Is it a double diagonal, or perhaps an out of the money vertical, or just a regular old diagonal? These are some of the more common answers I get. Let's take a look at a high probability condor, because high probability is right in the name. So this must be a high probability strategy, right? So if we look at this trade and we say, for example, we sell what they call a 10 delta short put and a 10 delta short call, and then buy some wings 30 points wide out to cover that risk on the short options, we get what we call a high probability condor, and it looks something like this. Now, early in our options career, one of the explanations we're given for as to what delta means is that the option delta is the option's chance of expiring in the money. In other words, a 10 delta option has a 10% chance of expiring in the money. We're then told if we do this high probability, or 10 delta iron condor in this case, that where we sell maybe a 10 delta option, that we have a 90% chance of making money with this trade. And not knowing any better, a lot of us actually believe this garbage. First of all, if you have a 10 delta iron condor and you considered the risk reward structure of the trade in dollars, and you took the stated odds of a 90% probability of winning, which are not the actual odds, by the way, but if you took the stated odds and for granted, and the market actually let the trade work out 90% of the time, in other words, you put on the trade and do nothing, and 90% of the time you win, and 10% of the time you'd lose. If we took that premise and looked at the potential dollar value of wins compared to the dollar value of your losses, the losses would be about 6 times your gain, or maybe actually a little bit more than that. So in this case, we'd get a $4,000 credit approximately. We would get a $26,000 maximum loss number, which essentially means that if we take these numbers and we have a 90% win-loss expectancy, we would win 9 total wins, or $4,000 times 9, or $36,000, and we'd have 1 total loss, or $26,000 times 1, minus $26,000, and over that 10-month period, we would get a gain of about $10,000, which I believe is somewhere in the 31% range. Not bad. However, if the results happen to deviate from statistics and the trade took 2 losses in 10 months instead of 1, if this was the case, you would have 8 total wins, 2 total losses for gains of 32,000 and losses of 52,000, which would result in a 77% loss in 10 months. That's not so good. Now, if you've traded common iron condor strategies in the past, you've likely experienced this already. You go in, you get very good gains for a while, and then all of a sudden, boom, in 1 or 2 months you get wiped out. This is very, very common for a condor trader. Obviously, if you're trading a large portion of your capital, this would be a major problem. Because of this, we can't let the trade get to the short strikes of our position. As a matter of fact, we can't let the trade get anywhere near the short strikes of our position, which means even if you take this 90% number for granted by selling your 10 delta shorts, any negative deviation from those statistics would wipe you out. Therefore, that 90% probability is not realistic, and we'd have to put some kind of a stop loss in place because you'd be devastated by a string of losses if you didn't. So let's take a look at what a reasonable loss number might be, say 1 times our credit, and take that into consideration. If this was the case and we got a credit of $4,000, we'd need to exit the trade if the trade drew down $4,000. So if we look if we look at this analyze graph and see where that might be and get an idea of where we're going to stop out of this thing. So if we let some time go by and the market goes down, we'll probably get a volatility increase, and I would guess that this T+0 line would probably be fairly accurate as to when we would get stopped out. So in this case, it's around 650. If the market were to go up, you can see the T+0 line is steep now, but generally what happens is a reduction in volatility will let this line rise a little bit. So we'd probably get stopped out somewhere around the 810 area. Of course, this might be a little less or a little more depending on market speed, but this should be reasonably accurate. If we take a look at our 650 and 810 strikes, then our theoretical chances of success, judging by the other standard, is we have a 25% probability of winning, a 25% probability of losing to the upside, and approximately a 17% chance of losing to the downside. On average, I'd say that's about a 20% chance of losing, which should translate into an 80% chance of winning. So you might say, hey, an 80% chance of winning with responsible loss numbers isn't that bad. And I'd agree. But wait a minute. If I have an 80% chance of winning, that means I have a 20% chance of losing. But the problem with a condor is I have a 20% chance of losing on the downside, and I have a 20% chance of losing on the upside. When I think about it that way, isn't it true I really have a 40% chance of losing? Which leaves me with a 60% chance of winning? That's a significantly different number than 80% chance. Now we can argue whether this is mathematically correct or not, but my point is that your odds of winning a trade, or this trade in particular, is a lot less than 80%. But that's not even considering the probability of touching that strike. If you've read options books in the past or looked at probability tables or whatever, you find that the probability of touching is much more probable than the probability of expiring. And just touching that area is what's going to fire off our loss number. Therefore, this trade isn't even 60% chance of winning in my book. But let's put that aside for now and assume that it is. Okay, so we're just going to say that this trade has a 60% chance of winning. So if we have a system that limits losses and stops out at the total credit and has the potential of making the total credit, that's assuming you played the strategy till it's full credit or full loss potential. And if that's the case, and we had a 60% chance rate, and we got a full credit or a full or a loss, the full amount of what that credit would have been, then we'd have a slight positive expectancy. So over a 10-month period, we'd have 6 total wins and 4 total losses, or 24,000 in wins, 16,000 in losses for an $8,000 or 31% return in 10 months. That's not bad. But this time, if the system does a little worse than expected, say we win 5 months and we lose 5 months, we have equal wins, equal losses, in that case, we get no return in 10 months. That's not the end of the world, right? At least we didn't lose 77%. So this is a little bit better than what our other strategy is. So, but what about adjustments? A lot of people, they don't just put the condor on and leave it. They do adjustments. So let's take a look at adjustments. And let's say we find an adjustment strategy for this trade that increases the probability back up to 80%. If we do this and we're still willing to risk our initial credit, what ends up happening is that our average win drops significantly because the adjustments in the trade, in most cases, are going to give you less profit potential. Unless, of course, you decide to double up on your risk, which I would certainly not recommend. But if you do that, you're going to increase the capital in the trade, which is also going to drop your percentage. So for this example, let's just say we find an adjustment strategy that increases our probability to an 80% win. But in the process of doing that, we're not increasing capital. However, we are cutting our wins down in half, which is actually something reasonable that happens if you've tested pretty much any Condor strategy that does not increase your capital involved in the trade. This is what's pretty much going to happen to it, is your total wins are going to be cut in half as far as a dollar value, yet your losses are still going to be the full credit loss. So if we were to do this and we were to win 80% of the time, our wins would now be $2,000 or half our credit. So our half credit win times 8 is $16,000. Our full credit loss times 2 is $8,000. If you do out the math, you get exactly the same return, 31% in 10 months. Again, not bad. The benefit to doing this, though, isn't so much the returns you get. The benefit is what happens if things don't go quite as well as expected. Well, in this case, we have, say we take 7 wins and 3 losses. So we take 7 half credit wins. We take 3 full losses for gains of 14,000, losses of 12,000, and we have a $2,000 or 7.5% return in 10 months. That's much better. Right? So now things didn't go as expected and we still made money. We did a little bit better than that. Of course, you could always do better. You could always do worse, but this is just a hypothetical example. And in a perfect world, this hypothetical example would be great. But unfortunately, we're not in a perfect world because there's something else going on here. If we take a look at the dynamics of the trade and the general market direction, most of the time, and I emphasize the word time, most of the time the market is going up. And in the real world, this is going to result in a much greater chance of losing the call side than losing the put side. And this is made worse because if we look at the dynamics of the trade, you get paid less money for taking risk to the upside than you do to the downside. In fact, if you look at how far of a move it takes to get stopped out of one side versus the other, it takes a much bigger move down than it does up to actually run into a problem here. Because of this, we can take the leap that if we were trading a bull put spread and a bear call spread, which is technically what we're doing, then we would have a much greater chance of losing the call spread than we do the put spread. And amazingly enough, if we actually back traded a no-touch call spread for the last 15 years and a no-touch bull spread for the last 15 years, we would find that the bull spread does drastically better than the call spread. And this is really interesting because if you talk to most Condor traders, they're much more concerned about the market moving down than they are about the market moving up. This phenomenon implies that the probability of a no-touch iron condor making money is probably even less than 60% over an extended period of time. In fact, if you go and back trade this, you will see an actual probability of this 65-day 10 delta iron condor being closer to 40%, which when you think about it, isn't that pretty much the odds of simply buying a stock and hoping it goes your way? So if we're talking high probability, the high probability iron condor isn't quite what we expected. Now, if we're really looking for a high probability trade, the highest probability trades we can use, assuming we're ignoring charting, of course, is going to be a bullish trade because the market goes up most of the time. That can't lose if the market goes up. Yet, is capable of winning with a reasonable market drop, or withstanding a reasonable market drop without drawing down. And the easiest way to do this is with a simple bullish vertical. Of course, there are other ways, such as a properly set up broken wing butterfly or a bullish diagonal and maybe a naked put. And of course, we have these other more complex trades that are very effective as well, such as the M3. But we're not talking about complex trades today. We're talking about simple trades. So out of these simple trades and out of the trades we're mentioning here, the bullish vertical is by far the simplest and most effective way to trade the market, especially in uptrending markets. So let's take a look at a version of the simple bull vertical. Now this is a trade that I've openly advertised at no charge for about 3 years now. I call it the bull. It's a trade that is extremely simple that anybody can do. It can be done on multiple index-based underlyings with little or no modifications. It has a track record on the Russell 2000 of losing only 2 years since 2002, and those 2 years were 2002 and 2008. It has an average yearly return of 22% per year since 2002 and including 2002 and 2008 with no technical analysis. It's had a return of over 61% in 2013. It's completely rule-based. There is no subjectivity, and it can be easily backtraded. And the entire trade plan is 7 bullet points. Does that sound great? Well, here it is. It's called the Bull. We simply do an entry into the market 65 days to expiration using the Russell 2000. We exit the market 37 days or 30 days to expiration, or more specifically, when the back month or the next trading month becomes 65 days to expiration. We also exit if the position is down $250 per lot or per contract. So per contract, this would have a maximum loss of $250. It would have a gain of $250, maximum gain. We'd have approximate planned capital of $2,750 per lot. The trade is as simple as selling a 30-point wide bull vertical with a short strike closest to 10 delta that you can get, and the long strike 30 points lower than that. If the maximum loss happens to be reached during the trade, we simply exit the trade and we sit at the sidelines until the next month is ready to go at 65 days to expiration, and you enter the trade. That's it. There's no subjectivity, there's no charting, there is no adjustments. I've shown this trade to hundreds, if not thousands of traders who've been struggling for years just trying to get profitable. I tell them, look, this is a simple way to trade that has historically outperformed any mutual fund I've ever heard of over the last 12 years, as well as what I'd estimate to be 95% of all retail traders. If you don't believe me, backtest it. It's so simple, you can backtest it for as long as there's been data in an afternoon. I beg them, I say please, until you learn to be a better trader, stop throwing your money away and just do this. And do you know how many do it? As far as I know, nobody. Sure, I might get someone who tries it for a month, or tries it and doesn't follow the plan. But as far as someone who's actually followed the plan for 6 months or more, there's been no one. Why? Well, the market's been up too much lately. Or, no, I'm not going to enter a bullish trade with the market this far up. Or, the market's going to be coming down. I know it is. Or they'll say, I'm not just going to sit there and watch the trade lose. You know what I have to say to that? It's really pretty sad when traders won't take a little short-term pain in order to be long-term successful. Instead of trading something that sometimes loses, yet wins long-term, they lose money year after year, strategy after strategy, hopping around with all these crazy complex trades just because they can't deal with letting a few trades lose. In case you haven't figured it out yet, that doesn't work. Of course, there's another theory I have as to why nobody does this, and it's because I've given away the information, and therefore people don't put any value on it or don't think it's relevant. Well, now I've charged you for it at this point, so now the information can be relevant and you can go ahead and give it a try. So let me show you a few examples of this. Here's what a bull entry looks like. In this case, it's 12 contracts. 12 lot would give us a planned capital of between $32,000 and $33,000 usually, with a $3,000 profit potential. In this case, it's 12 contracts. We enter 65 days to expiration, and we have an expiration graph that looks like this. Therefore, if we're backtesting this strategy, we can simply put the trade on, take a look at our chart on our entry day, see what the market did. If the market didn't drop significantly below, or if the market never came near our 736 number, we can just simply go to the exit date, because in this case, the trade would not have had any difficulty. We can simply run to our exit date and see what the results would have been. So in this case here, we had a $3,200 gain. We are now 65 days to expiration, which is our exit date. So assuming we weren't stopped out, in this case we weren't, we simply exit the trade regardless of our profit and loss, and we enter our new position. We sell our 10 delta shorts, we buy our 30-point wing, and we're in our new position. This is what happened to this trade. It happened to be a winner. However, like I said, whether the trade was up money or down money or neutral, the trade is exited and it's moved on to the next month. This is an example or showing a losing trade. If the trade happens to draw down the amount of credit received prior to the exit date, we simply close the trade. We wait until the next trade is 65 days to expiration, and then we enter the market at that point. So let's exit here the slideshow, and I'd like to show you just a cycle of trades and how it might work out over time. Okay, so here we are, 65 days to expiration in October of 2014. The date is August 13th, 2014. We go down to our 10 delta. We sell 10 puts. We buy 10 30 points lower. It gives us a cash flow of $25.70, which is pretty much what we want. If you remember when we looked at the rules, we want to get $250 per lot. This is a 10 lot, so we would expect $2,500 in credit, and that's going to give us a maximum risk in this particular example of $27,430. Our analyzed graph is going to look like this. Now, if we're back trading this, we can simply take this entry date. We can look at our charts on August 13th, which is approximately right here. We can see for the duration of our trade, which is going to be about to the middle of September, that there's really no issues. In other words, the market doesn't come down significantly, nowhere near our stop area. If we look at our analyzed graph, you can see we've collected about $2,570. In order for us to get stopped out, the market's going to have to go down to approximately 1085. So if we look at our chart and we see that that didn't happen, then we know all we need to do is we need to cycle forward to our exit date, which happens to be September 17th. See our result as we made $2,010. While it's true that we could stay in this position and get the rest of the money out of this, that is not the trade plan. Therefore, we exit the position and we move on to the next month. So here we go. We exit this position. We look at approximately 10 delta. In this case, I had a choice of 9.86 or 11.4. As I'm going to show you later, it really doesn't matter which one of these you pick. In the program, we would like to receive at least $2,500 for 10 lot or $250 for a 1 lot credit. In this case, I probably could have used either. I just chose the 11 delta put, which is perfectly fine. If I come in here, it's September 17th. If I look at my chart on September 17th, I see that the market dropped down like crazy, right? So good chance I'm going to get stopped out. I can estimate what day that would have been by just seeing when I'm drawn down in $2,800 here, which is around 1105. So when the market hits around 1105, which happens to be about this level, which would be on the 30th, when it hits the 30th, I'm probably going to get stopped out. So I can just kind of push this forward to the 30th. If I look at my T-log, since I've already done this, I can see I get stopped out on the 30th. Huh, that's kind of interesting. So let's just move forward to the 30th. And we see we're down to the 1105 area. We're down about $2,800, a little more than $2,800, which is pretty much expected, right? So we simply close the trade. We're not ready to open our December trade yet because we're not 65 days to expiration. We close this trade. We wait until December is 65 days to expiration, which is somewhere in the middle of the month on a Wednesday. We come here. We enter our new trade. We sell our 10 delta short strikes. We buy our 30-point wings. We have a credit here of a little bit less, right? So in this case, it would have been beneficial for me to actually go up to the 12 delta. It's okay to use the 10 delta, but if you want your trading to be more consistent from a profit and loss standpoint, if you remember, I took a bigger loss on the month we lost because I actually gave myself more credit. And if I'm using a one-to-one ratio, that allows me a bigger loss number. So I certainly could have come up to the 12 delta in this particular case. Either way, this is fine. We have our credit, which is a little bit less than what it should be. Here is our analyze graph. Again, I can pick my number here. I can say, we got 2370 credit. I can say I get stopped out at 2370 loss, which is going to be approximately, let's see, about 1,007. I can come back here, close this. I can look at my charts for October 15th. Here's my October 15th. I never hit the 1007 level, nowhere near it. So again, this trade is going to be perfectly fine to the upside. So I can just simply go to the date where this is going to exit, which is going to be somewhere in the middle of October on a Wednesday. I'm sorry, middle of November on a Wednesday. Let's try the 12th. Yep. My January is now 65 days to expiration. I've made my gains here. Here is my position. Here's my position here. I simply close this position and I move into my January trade. Same thing. I do 10 delta. It's going to net me around $2,500 with a 10 lot. And this one's a little bit more than $2,500. Again, that's perfectly fine. Here's what my position looks like. I can estimate when my maximum loss is. I can come in here, I can look at my charts. I'm on November 12th. I come in here, I look at my charts on November 12th. So this one I may or may not have run into a problem. Let's see. The stock market essentially goes down to 1150. If I look at my analyzed chart, is 1150 going to give me a problem? Well, I have about $2,600 in credit. At 1150, I'm only down around $1,000 or so. So chances are, no, that's not going to give me a problem. Therefore, since that's not going to be a problem, I can just scoot up until the following month. So I pick a Wednesday in the middle of December. It's probably the 17th. I am correct with that number. I really didn't make anything. The market's flat. This is where a lot of people have the temptation to stay in the market to see if it works out or all this other stuff. No, we're following our trade plan. We exit this trade, we go into the following month. So we come in here, we exit this, we go to the 10 delta in our outgoing month. Here is our new position. Again, we go to December 17th, we take a look at our charts if we're back trading. Of course, if we're live trading, we don't know what's going to happen, but this is a way to back trade quickly. So this is when we entered. Obviously, we're not going to have a problem. So we can just take this and scoot forward to mid-January, which should be about there. We've made some gains, but it's time to exit. So we're just going to simply take this trade off, move into our March position. Here is our new March position. If I looked at the charts, I would realize that the March wasn't going to be a problem either. So just quickly move into the middle of February. And this would complete 6 months of, let's see, let's go a little bit further. This would essentially complete 6 months of trading this. So I've closed out of my March position. Let me go into Wednesday. So at this point, I've closed out of my March position and I've opened my April position. If I take a look at my reports, I can see how I've done. A $1,900 gain. I had a $2,800 loss, again, because I traded larger than normal that month. If I traded more normal size, the loss would have been a little bit less. I probably could have done a little bit less delta. I could have done a little bit more delta here and done better. I made a $340 gain in the following month, and a $1,250 gain, and a $1,720 gain. All in all, our 6 month period here, we had 1 loss, 5 gains, which is fairly normal. And we ended up with a $46.90 gain on $27,000, which is approximately a 17% gain in 6 months, which is pretty darn good for a strategy that's that simple. And keep in mind, we're not in an uptrending market here. We are actually, if you take a look at the pattern that we've been over in the last 6 months, it's been kind of choppy. We're pretty much we're not a whole lot higher than we were. So just doing this is very powerful. So let's get back to the slideshow. What usually happens is I get common questions about this strategy, and some of the questions are something like, well, can I use a different delta, or can I use wider or more narrow wings? Can I use different underlyings? And really, generally anything is fine as long as you're following the concept that you can't lose when the market moves up. I get paid for downside risk. I don't lose more than I win. Right? If I exit the trade far from expiration, it works out very well. The only thing I would avoid doing is trading stocks, unless you're trading a very small capital level, because stocks can cut their value in half overnight. If that happens, you're going to lose more than you're expected. You can lose more money than expected. Therefore, you should be trading smaller. I'd also avoid inverse ETFs. But other than that, you have a lot of latitude in what you can do here. In fact, if you took these different strategies, in other words, you took the 10 delta bull vertical I've just shown you, and then you did the same amount of money or risk in a 16 delta bull vertical, or the same amount of risk in the at the money naked put, or you even took a bullish diagonal, and you did these strategies over time since 2002 or since the end of 2001, then the results are remarkably similar. So for example, if we take the 10 delta bull vertical and we put it in a situation where we know it's going to lose, right? This is September of 2008, right? Market essentially pretty much straight down from here, right? This is definitely going to be a losing trade. But if I took this and I did the trade we were just showing you, I sold my 10 delta puts, I bought my 30-point wings, I get out at my maximum loss number. If I were to do this, I have an expiration graph that looks like this. I would have been in the trade from 9/17 to 10/2, which is a total of about, I don't know, 25 days, 24 days. At that point, I would have hit my maximum loss number because the market pretty much went straight down from there, and I'd have to exit the trade. This trade lasted with the down move till 10/2/2008. This is what it looked like when it lost. If I took the same thought, remember the date, October 2nd. If I took the same thought and I did a 16 delta bull vertical, which is actually closer to the money, and I did it the same size, and I used the same 30-point wings. If I were to do that, most people would think that I would lose money faster because I'm closer to the money, right? And in fact, if the market's coming down, what a lot of people do is they go further away from the money because they want to be safer. Well, let's take a look at that. I put this trade on. This is my current entry position here. This time, if I play this trade out through my virtual straight down loss, this trade actually lasted a day longer than my 10 delta vertical did. Right? So I'm closer to the money. Under the exact same circumstances, I lose money faster with a 10 delta bull vertical, or I stop out sooner or lose one day earlier with a 10 delta vertical than I do with a 16 delta vertical. That's kind of interesting. If we take a look at the graph of what this looked like when it lost, looks like this, right? Pretty much similar as expected. What happens if I use an at the money naked put? This is going to get creamed, right? This is the same entry day. I'm only doing one contract here because really if I do one at the money naked put, I'm going to get a similar return on that as far as from a profit level if the market goes up than I would from doing 19, 10 delta bull verticals or 12, 16 delta bull verticals. So essentially from a risk reward ratio, this is the same trade. So if I did this, and that would give me a position that looks like this, and I just kind of let it ride until I lost my credit, which in this case was about $4,000. If I did that, this position would actually last till 10/6. If you remember, the 10 delta vertical lasted till 10.2. The 16 delta vertical lasted till 10.3. The at the money naked put, before I get stopped out, lasts until 10.6. 2 trading days longer than my 10 delta vertical. That's kind of interesting. So I had a 10 delta vertical. It lasted a certain amount of time. My losses were less at that same point with a 16 delta vertical, and they were even less than that with a similar naked put. That goes a little against common thinking, doesn't it? Well, you know the problem with these strategies out here is that you used all the same month options. You have negative volatility problems. Okay, so let's take a look at a diagonal. Diagonal's not supposed to have negative volatility problems. Although if you look at the negative volatility number here, it's just as bad as the naked put. As a matter of fact, your negative volatility number is actually greater than your naked put. But it's common belief that a diagonal is positive vega and that it's better than a naked put in a down move, right? So let's take a look at this trade. This here is an 8 lot. Again, we're 65 days to expiration with our short, and we're taking our long out here at 520. This is pretty much the combination I had to make up to get a similar profile as I did with the vertical. So if we look at this, we have approximately a $4,000 gain if the market goes up. We're off to the races, right? So here we are, and we're in a diagonal. We're safer from volatility. Well, if you take this and you project this forward, this trade also lost on 10.3. It did outlast the 10 delta vertical by 1 day. It did not outlast the 16 delta vertical, and it certainly didn't outlast the naked put. So hopefully this is a little bit eye-opening to you guys, that the reality is you're not really any safer entering a 10 delta bull vertical than you are doing a naked put in the marketplace, other than you have undefined risk, right? That's something to be said in itself. If we had a catastrophic event, the undefined risk, you could eventually lose more than you could with the verticals, maybe. You have to take a look at how far, you have to take a close look at how far the market's really going to go down and what your actual risk is. But in general, what I'm saying is this should be eye-opening to everybody. So here's what we look like the lost day of our diagonal with the similar risk profile. Now, keep in mind, not only did the market move down, but we had an extreme implied volatility increase through this session. And despite that, we're still doing well with the at the money naked put. Again, not that I condone necessarily selling at the money puts or naked puts in general, but they are effective. And it really doesn't matter if you're selling them at 5 delta or you're selling them at the money. They're pretty much equally effective either way. Now your win-loss ratio is going to be different, as we'll go over in the next slide. So anyway, if we have a analyzed graph comparison of all these strategies, you can see their potential win for the most part if the market moves up is about the same. The diagonal, this is not a stable line on the diagonal. This line can drop with a volatility decrease. Therefore, my upside win is may not be what I expect. But in general, assuming we have a stable expiration line, then we should win about what we win in a diagonal if the market goes up. Win potential in my verticals is the same, and the win potential in my naked puts the same. This is going to create, if the market goes up, going to create very similar wins. If the market comes down, it's going to be a little bit different. Essentially what you end up with is something like this. We have results from the different strategies are different results, but the net is about the same. So if we get an at the money naked put, if you take a look at the margin you're charged from at the money naked put, and you look at the gains and you do a percentage, the at the money naked put, size for size, has the greatest percentage of wins. However, it wins the least often, which would be expected, because essentially if the market goes down a small amount, you're not likely to win an at the money naked put. However, like I said, the percent wins are bigger, so that kind of tends to even out. With a 10 delta bull vertical, this is going to tend to win the most often in most environments, However, the percentage gain you're going to get from a profit and loss standpoint tends to be the least. If we take a look at a 16 bull vertical and the diagonal that we were discussing, that win and loss ratio is in between the two. Overall, they essentially return the same amount of money, which is really what we're concerned about on their risk. So I thought that was interesting, and I thought you would think it was interesting as well, so I figured I'd share it with you. However, for now, just try the bull guidelines, right? Get in there, do your trade 65 days to expiration, or get in there and back trade it. I always suggest back trading first, but get in there and back trade it, try it out on paper, try it out live, and then if you'd like to experiment with it, then go ahead. Essentially, as long as you stay with the concept, you can't lose to the upside, get paid for taking on downside risk, and you stop yourself out when you're down 1 times your potential gain. The system works very, very well. One of the things I would do, however, is to add a filter. I'm a little hesitant in general to add filters because most of the time when people add filters, they end up losing more often than they would have if they'd done nothing at all. I see this time and time again through hundreds and hundreds of traders. They take a strategy that's perfectly good, they add filters because they don't want to lose, and they lose more. So very, very common. But some filters do make sense. In this case, the bullish vertical, this strategy did poorly in 2002 and it did poorly in 2008. There is a filter that can keep you out of those markets, and that's the VIX. So essentially, it's not the market move down that kills you. The market move down will cause you to lose a trade. That's not a problem. That's all built into the system. However, when you're in a bullish vertical, an extended down move over a period of time or extreme volatility and entering with bad timing will throw you out of the trade more often than not. So that being the case, we want to stay out of those conditions. Of course, in 2002, we didn't have the VIX, so we don't know what the VIX was, but we can go with 2008. In 2008, the VIX was clearly over 35, and if we put that filter in there, that would have kept you out of 2008, the market crash. I mean, you would have got nailed 1 month, but the rest of the year, you would have been out of the market and you would have been fine. In 2010 and 2011, yes, we lost some months because we had a market crash in there, but they were short market crashes. And from an annual standpoint, the strategy did fine. So we want to stay out of these extended down market, these extended market crashes. And usually it pops the VIX over 35 if something like that happens, or a lot of fear comes in the market. So we can put a pretty reliable filter in here of don't trade VIX over 35. You could also use an RVX over 40. But I like to attach it to the VIX. And that would have kept you out of most of the problems that we had during that. So again, very, very effective strategy. Here's the guidelines with the VIX filter. Go ahead out, give it a try. In session 2, we're going to go over the simple bearish butterfly, and we're going to combine that with some simple charting. So go ahead, experiment a little bit with the bull, and I'll see you in session 2 where we talk with the bearish butterfly.